So good afternoon and very warm welcome to our this session on the dimension of our development finance and programs that are of a key significance when we talk of our partnership and also in terms of evolving the idea further. I'm so glad that today we are joined in by Madam Shyamala Gopinath, the former Deputy Governor of the Reserve Bank of India, my own former colleague and later on joined IDBI Bank, Mr. G.A. Tadas. We are joined in by my old friend and one of the renowned global authority on international banks and finance, actually access to finance, Stephanie Griffith-Jones. So I'm very thankful to her for joining us and giving us the support that is needed in terms of further analyzing the issues that are of great significance. We are also joined in by Mr. Dr. Janmejay Sinha. We would be introducing the speakers. Of course, in our letters, we have already mentioned the details. I would also like to mention that on the board of the RIS, so we are extremely privileged that she has joined us today as chair for the seminar. Friends, given the kind of crisis that COVID has posed to global architecture and also the dimensions of choices, the policy choices that we are left with, the failure of the market is extremely clear. And what policy choices we have for having the institutions that can form of development for quite long, actually. In the COVID crisis time, this has accentuated further the need to have this instrument further explored. Though the multilateral, the regional development banks, etc., are playing the major role that they are expected to play. The role of the institutions like the national development banks, what role they can play when you have to be on the trajectory for national development plans is an important dimension. The second issue, friends, is in terms of our idea of access, equity, and inclusion when we talk about finance. And that, I think, is important, particularly when we are thinking of several derailments in demand, supply, in the market. And growth. And that, I think, poses for us. In India, we have been discussing issues related to differentiated banks for quite some time. But it was only in 2015 that India issued the licenses for private sector banks. And if you see the broad evolution, there have been discussions at the Reserve Bank of India, as Ms. Shyamala Gopinath would tell us. The whole idea of wholesale and long-term finance, WLTF, was discussed both in terms of focus on primarily on lending for infrastructure, for small and medium, and of course for corporate business. And these banks that were actually ideally to provide refinance to lending institutions. And also in form of supporting the aggregators. And that, I think, is important because if you see the universal banks, they were already doing the deposit accounts, personal loans, etc. But as we are growing and all the developing countries, and it's not just about India today, we are focusing India, but it's true for almost all the developing countries. So as you move beyond universal banking, more and more complex sort of services are required and are expected from the banks. And that is important because the wholesale side of it brings in the term loans, the project finance, the debt syndicate, and of course, investment banking, trade finance, among many others. So there are some today we would be exploring as to whether we really need the National Development Bank, and in India's context, after privatization of IDBI and ICICI, we have been looking for finance from outside India, maybe at a higher cost. So what kind of development bank we can really think of, the whether it would be in the private, public, or foreign sphere, what kind of business model it can bring forward, and above top of all that, what kind of regulatory framework it offers. So these were some of the issues, friends, that I wanted to highlight, and I thought would be important for us to begin our discussions with. Now, without further ado, I would like to request Ms. Shyamala Gopinath for chairing the session. I would like to mention at the outset that Ms. Shyamala Gopinath was not only was the deputy governor of the Reserve Bank of India, but she was also on the board of directors of the Reserve Bank of India. She is right now an independent chairperson of the board of the HDFC Bank in India. She's CAIIB and has served in various capacities with various committees of the Reserve Bank of India, and also with International Monetary Fund, and also some committees of the SEBI for regulation purposes. She's also on the board of the Indian Oil Gas Corporation Limited, and also has been serving as key policy maker on how the financial positioning that India envisages is there. As I already mentioned, she's also on the board of the RIS. So, madam, the floor is yours.
Yeah. Thank you very much, Sachin, for inviting me to chair this really I'm sure it's going to be a very thought-provoking session. And being the chair is a privileged position, since I'm looking forward to listening to everyone. And we have such excellent speakers here. Both Mr. Tadas is here, and Stephanie Griffith-Jones and Janmadeh Sinha. I just want to, I wouldn't take much time, just make a few remarks to say traditionally infra investment had been financed by public funds in most countries, initially. Maybe US was an exception, they had the bond market. But in most other countries, and even today in China and other nations, it is the government that funds the infrastructure. But with increasingly the fiscal space being limited for countries, particularly for India, we have to look for other sources of financing infrastructure. Our needs are huge. Well, we did have development finance institutions like the IFCI, ICICI, and IDBI to cater to the long-term financing needs of the economy, and they did finance long-term projects. They were given special access to get funds, long-term funds from the banks, because the bonds issued by them were treated as what we call the SLR. It was eligible for purposes of meeting the statutory liquidity ratio, and therefore the banks were happy to invest in these bonds. But even so, increasingly it was becoming difficult for them to raise low-cost sources of financing. I mean, in any event, at that time the interest rates were high, and even the projects they financed got into several difficulties. In some cases, there were diversion of funds by the promoters. They built up a large, amount of stressed assets, and a committee that went into the future of these institutions finally recommended that it's given all the challenges that these institutions face, I mean, threatening the viability of these institutions, it's better, we either merge them with banks or convert them into banks. So, but then with infrastructure development becoming a thrust area for the country, banks rapidly increased their financing to this sector. And this particularly happened post the GFC, when huge liquidity was available to the banks, and at lower cost, and they didn't really have, they didn't know where to invest profitably these huge funds that were made available through the Reserve Bank's accommodative policies and various other policies. And they did start financing infrastructure, but without having the in-house skills or fair understanding of the operating environment. And in the process, over a period of couple of years, again, even commercial banks ended up having a large, NPAs in the infrastructure. Of course, the reason was not just the lack of skills. I mean, Tadas will probably explain. It was also the fact that, actually it was a whole lot of factors that led to these assets getting stressed. Among them, the regulatory uncertainty, the lack of regulatory approvals, as well as very high leverage, very low equity financing, and again diversion of funds. So a whole host of reasons. I mean, each project has a different story behind it as to why it got stalled. There have been some successful projects where all regulatory approvals were given. I think some of them are there where it was good. In India, the challenge is really in terms of financing, these long-term projects and the early stage financing. The pre-project implementation financing. Once the project is ready, it's very easy to monetize that at that time. But otherwise, it becomes a huge problem for banks to fund infrastructure, and now they are really not ready to take on this burden. And therefore, we need to. Therefore, it's very appropriate that RIS has organized this. We need to consider whether how really we handle this huge deficit that is there in the funding for infrastructure projects. As I remember one bank chairman saying, "Show me a bankable and commercially viable project, I'm ready to fund." So, I mean, this is where we are. Banks are not even sure which projects are viable, which are bankable. So this is where I think development finance institutions with a combination of expertise and the funding ability should be able to step in. But then there are several questions, because we don't want to create institutions just to again make them non-viable. So we need to have a viable model, and that is extremely important. With this, I stop here, and I think we should ask. Now we can.
Thank you. Thanks, Madam, for your initial remarks. I would now request our keynote speaker, Professor G.A. Tadas. Mr. Tadas, as I mentioned, has worked with the IDBI Bank of India for almost 24 years. He's an economist and worked with IDBI for all these years in all different capacities. He has specialized in project appraisal and risk management in corporate banking, and was responsible for all different portfolios that the IDBI Bank manages. And before that, he was also with my own institution, RIS, many years ago, and had done a pioneering paper on mainstreaming of gender for economic development, and also on basic needs with RIS team, with Dr. Mohanty and others. So he has that combination of a very long period being as a banker, but also as an economist, and that's the reason why we requested him to do this paper on development. So without further ado, Mr. Tadas, I request you for your presentation.
Thank you, Dr. Sachin. At the outset, I would like to place on record my gratitude and heartfelt thanks to RIS, and in particular Dr. Sachin, for organizing this very important webinar on the topic of the choices for development finance in developing countries. As Dr. Sachin mentioned, I was with RIS at the beginning of my career. I almost served that institute for 10 years, and subsequently I joined the erstwhile Development Finance Institution, that is IDBI, and I worked there till recently for almost more than 2.5 decades. And during my stint at IDBI, I worked on project finance, corporate finance, risk management, and various other facets of banking. That sense, I have a blend of both research and development finance practitioner. In fact, at one point of time when both Dr. Sachin and myself were discussing, it occurred to us कि why not work on this area, because the fact that presently we are undergoing the financial crisis worldwide, and also that most of our major DFIs are no more functional because they have been transferred into commercial banks. So I readily accepted his invitation, and I have put at one place all the major developments in this area of development finance institutions, the vast literature that is available on the subject, and my own thoughts on what should be the path going forward. At the outset, again, I also want to thank the esteemed panelists, Madam Shamla Gopinath, former Deputy Governor of Reserve Bank of India, Professor Stephanie, and Dr. Janmej Sinha for kindly, making themselves available for this webinar. And I am indeed privileged. In fact, I am more curious to hear their thoughts and comments on my paper rather than my own interest in presenting the paper. But of course, I will do my best to present my thoughts, and I will take maybe about 15-20 minutes, and then I'll be eager to hear the comments from not only the distinguished panelists, but also other distinguished participants who have participated from various countries. As you all know that we are as a country and as a global economy undergoing the COVID pandemic situation, which has adversely affected the economies across the world, whether it is developed country or a developing country. The industries, whether it is large scale industry or a small enterprise, all of them have suffered. The employment has been adversely affected, especially the marginal and the poor people and the daily wage earners have been affected the worst. So when you are facing such crisis, and when you find that the existing institutions are not able to cater or meet the emerging needs in this financial crisis, then the question arises as to who should address the market failures. Of course, we have the government, not only in India, but also across the world, governments, actively intervening and announcing various stimulus packages. In India also, we have the government of India has announced stimulus packages to address not only the large corporate sector, but also the small industries, the contract workers, the agriculture, and the financial inclusion aspects. If you look at the aggregate stimulus package, the amount, both the fiscal as also the monetary part including, it amounts to about nearly $150 billion for the India. And apart from this, RBI also has come out in support of banks, NBFCs, and other financial sector players to support their the day-to-day operations, so that they tide over the existing crisis. And that package almost amounts to nearly $120 billion. So the governments have been taking active role, active the intervention measures, so that the impact of the present global pandemic crisis is mitigated, and that the economy comes back to the growth path again. As you all know, the estimated growth rate for the world as a whole is expected to contract, and for India, various projections have been made, but on an average, you can say that the estimated there is going to be contraction in the Indian economy to the extent of over 4%. This is what is estimated by many organizations and experts, including the World Bank and IMF and others. Uh, Now, when we deal with the market failures and when we deal with the who has to bridge the gaps which are not being addressed by the existing financial players, there comes the question of an institution which is an overall umbrella institution which will come to the help of not only, of course, the financial crisis situations which are once in a while, like we had 2008-9 financial crisis, and now the financial crisis as a consequence of the COVID global pandemic. No, these are financial crises happening once in a while, and even during these financial crises, we have seen in the past and now also that the major development financial institutions in European countries and elsewhere, they have been actively intervening and then helping the industry and then the small and medium enterprises to tide over their immediate problems of liquidity, of operational difficulties, so that they keep floating till the pandemic is over, and then they are able to come back to the normal path of their operations. uh, Now, we have a panelist, Professor Stephanie, who has worked extensively on areas of the international capital and financial flows, and also on the development finance institutions and their critical role in addressing the market failures. I think she'll be able to throw more light on these aspects. What I am going to do is to focus more on the Indian economy, how the development finance institutions have been contributing, and then what is the present state of affairs, and how is it that going forward we should be able to address market failures not only when there is a financial crisis, but otherwise also in the normal circumstances in a developing country. We have various needs of infrastructure development. We have needs of small and medium enterprises. We need to address risk capital and venture capital. And we also need expertise who can, address issues of project appraisal, project monitoring, and putting in place proper risk management systems, so that the long-term finance is on a smooth path. Uh, as Madam Gopinath was mentioning in the beginning, we had three major financial institutions in the country, which helped a lot our national development goals since the post-independent era. We had IFCI, which was formed in 1948. We had ICACI, and we had IDBI. In fact, I may mention here that IDBI was initially part of Reserve Bank of India. Subsequently, in 1976, it was hived off as a separate entity. Now, these institutions have contributed significantly towards long-term credit and project finance, and you can say that the industrialization that has happened during the decades of 60s, 70s, and 80s was mainly attributed to the contribution made by these development finance institutions in India. In addition to these major development finance institutions at the macro level, government of India also set up the sector-specific development finance institutions, like the Power Finance Corporation, the Small Industries Development Bank of India, and we have NABARD for agricultural and financial inclusion development. Now, why we need development finance institutions in especially the developing countries is mainly because if we leave the developmental aspects, whether it is infrastructure development, whether it is small and medium enterprises, or whether it is the startup or venture capitalists, then the private sector financiers, whether it is banks or NBFCs, they will be basically led by the potential promising cases. Now, which means that the commercial considerations will be higher, because obviously, their main objective is to see that whatever they finance is, within a certain horizon of 3 to 4 years time, and that, they are sure of achieving certain returns on that. But then, there are the infrastructure projects which require long gestation project finance support, and the returns are expected over a very long period of time. And not only that, there are various issues in terms, of implementation, in terms of regulatory guidelines, in terms of policy guidelines, and then there is a complex structure. For instance, in the case of power projects, you need to have, the arrangement with the raw material supplier, like the coal or other raw materials, on a long-term basis. And then when you produce power, you also need to have a long-term arrangement for supply of power through power purchase agreements. So all these involve, a long gestation view about the projects, about their development. And, if we put in place these mechanisms, then, there will be some certainty as regards the cash flows generated from these projects. But then, the private players would not be interested in these long-term, goals or projects, because, they would not like to wait for 10, 20, 25 years. In fact, when I was in IDBI, I myself appraised certain, like seaport projects or airport projects. The concession agreements run in 30, 40 years, and the cash flow generation from the project repayment point of view is running into 25, 30 years. So definitely, the private sector banks or the commercial banks, even though they are government supported, they would not be interested to expose themselves to these long-term projects. So in fact, when we were financing these long-term projects, commercial banks would pitch in for providing working capital facility. So there used to be some sort of a complementarity between the development finance institutions and the commercial banks, because ultimately, the if the development finance institutions support is required to set up the project, and the funding is required on a long-term basis. For running them on a day-to-day basis, working capital is required, which DFIs would not be extending, and they were depending on the commercial banks. So there was some sort of a complementarity. But however, as we forged ahead, we as a country faced a financial crisis in the early 1990s, and then we had to undertake economic and financial reforms in the year 1991. And consequent to that, there were substantial changes in the way the liberalization of the economy, the industry, and the financial sector was viewed. And the view was taken that it is better we give scope for private sector players to enter the banking arena, and that transform the existing development finance institution to some kind of a universal bank. So you see that these ICICI and IDBI converted themselves into a commercial bank. In fact, in IDBI, we converted ourselves into a commercial bank in 2004, and ICICI did it a little earlier to us. So with the transformation into commercial banks, the long-term funds which were available at reasonable cost were dried up, and the cheap resources which were also available to the development finance institutions, either through SLR bonds, as Dr. Shamla Gopinath was mentioning, or through the tax-free bonds which were issued by these DFIs, were no more available. So these banks had to depend on the market mechanism to raise resources, and the cost of funds accordingly was higher. So they could no longer give on a long-term basis at reasonable cost. Accordingly, the funds available to the projects on a long-term basis dried up, as the DFIs were not capable of raising these resources at the said terms and the rates. As a result of their transformation into uh, commercial banks, if you see, since the financial crisis of 2008 and 9, till date almost, I don't find any major long-term project being financed by any of the banks in India. Of course, apart from these DFIs, when they were themselves transforming into commercial banks, uh, some other forms of development for banks came into existence. Like we had, Infrastructure Development Finance Company, we have India Infrastructure Finance Company Limited, but they had a specific, the goal, and they could not cater to the requirements on a larger basis. But of course, IDFC also is no more DFI in that sense. And IFCL and other operations, if I look at them, virtually no major project has been financed by them over the last decade or so. So I would say that although it may appear a little, exaggerated, the project finance has come to a standstill in the last over a decade or so. Now, whether this is desirable for a developing country like India, where there are many situations of market failure, and where the players who do not have access to the existing financial sector, they do not have access to the funds. They will be looking for somebody who would come forward or who will meet their requirements. Now, whether there is a need for the DFIs or not has been discussed a lot in the literature. I need not go through the vast amount of literature that is available. In fact, one of our panelists is actively involved in research on these issues. She will also be giving her views on this. And recently, I was going through her works also. Apart from addressing the financial the crisis situations, they have also been addressing issues of financial inclusion and social and environmental projects. Social and environmental projects, as you can see, uh, cannot be or will not be addressed by the existing, private sector or even the public sector commercial banks. So, to address these market failures and to address the gaps which are there in the economic structure, we need a nodal DFI which will look into the requirements of various sectors. Of course, I do not mean here say that the it will go into each and every area. Being a nodal DFI, of course, it will be having a mandate from the government, and it will be looking at the national development goals. And if let us say national development goal is to promote infrastructure development, is to promote financial inclusion, is to promote SMEs, and is to promote venture capital. So I think this nodal DFI can look at these sectors which are subservient to the national development goals. Now, I think under the circumstances, what is required is to review whether the fact that we closed or we virtually ended the era of development finance institutions, whether that was required or whether that needs to be reviewed or it needs to be rethought about. If you see whether it is developed country or developing countries, uh, development finance institutions have continued to operate for a long time. And for instance, in Germany we have KfW, in France we have BPI, in Spain we have ICO, and in Italy CDPI, and in China we have China Development Bank. In Korea we have Korean Development Bank. It is not that the whether because they are developed countries they don't need a DFI. the DFIs or development banks, they are also required there, as pointed in the literature many times, that they need to address the issues of social infrastructure, the issues of environment, and the issues of financial crisis, wherever there are market failure situations. So these DFIs have contributed significantly in one way or the other in the developed countries as also in the developing countries. The issue, I think, is whether we need them or not is not an issue. I think they are needed, they are required. The issue is whether uh, they need to, their performance, their relevance need to be reviewed from time to time, so that they remain useful based on the changing priorities of the government, changing priorities of the economy, and changing structures of the economy. So from time to time, my feeling is that we need to review the performance of these development banks, so that they remain relevant, over time, and they continue to, serve the national development cause. Uh, Otherwise, the given the resources structure of the commercial banks and other NBFCs, they would not be able to address these requirements of the sectors, which are left out of the system. Uh, Now, what I have done in this paper is basically to give you an overview of uh, what is what are the main issues, in the DFI, what are the main issues, the DFIs and the finance and the development, what are the interlinkages in finance and development, whether finance should lead development, or development is there and hence finance follows. There have also been supply leading and demand following approaches. But I am of the view that in a developing country like India, supply leading approach is important. Wherever demand is there, the existing institutions will take care. But we need to address, as pointed out in the paper, and also by Dr. Sachin and Ms. Shamala Gopinath, we need to address market failures, and we have ambitious plans. If you look at the government announcements on the infrastructure development, or even including the present stimulus package, which runs into $150 billion. And there are issues. SMEs are virtually, many SMEs are suffering because of the COVID crisis, and there is a large scale unemployment. Now, if you have a development finance institution, I think based on the changing circumstances, they can change their role, and then meet the requirements of the emerging situations. I thought that this could be a beginning of the work, but there are many issues which need to be addressed going forward. For instance, this is a macro view as to whether DFI is needed or not, and based on the available work, and based on the fact that the capital formation, the project finance virtually, capital formation as a percentage of GDP is going down. Project finance virtually has come to a standstill. So given all these things, there is a I feel that there is a need for a development bank in India. But as mentioned by Ms. Shamla Gopinathan, we should not be just creating institutions. We need to have a mechanism so that the performance, the contribution, and the relevance is reviewed, and that their presence is effective and efficient and useful. Uh, Now, the main issues which still need to be, which can be researched further from Indian point of view, is that now I would say that from study point of view, we can say that post independence till 2010 and post 2010. Now up to 2010, these DFIs, although converted into a commercial bank, they still contributed to project finance. Post 2010, the project finance, the long-term credit has gone down substantially. So we can see the presence of these DFIs and their contribution can be studied at depth, so that further light can be thrown as to whether their performance was as expected of them during that period, or whether there is any change in the mandate required. And then second is the we can also look at the like various companies or corporates or firms have taken long-term credit from these development banks. Now, the firms which have taken long-term credit, whether they have been able to grow and increase their scale of operations, if that is so, then which means that there is a case for a development bank which can support on a long-term basis. So this also needs to be, I think, studied at depth. And then the issue of raising resources. Now there was a time when these DFIs were mainly dependent on the government support, like the SLR bonds and the tax-free bonds. Some of that may be required, but whether there are new ways of raising resources so that the dependence on the government is reduced. So we can look at the practices followed by development banks elsewhere in the world and then draw lessons from there. And then in regard to the governance structure and the ownership structure and the risk management system, I think there is a need to learn a lot from the best practices adopted by the development banks, which have been successful and continue to operate in the developed and the developing countries. We need to look at those best practices and then draw lessons from them, and then see if at all we decide to have a new development bank, then what should be the structure of ownership and what should be the governance structure, so that their contribution is optimum, is efficient, and that they continue to remain relevant. I think with these few of my thoughts, I stop here, and I look forward eagerly to hear comments from others so that I can further improve upon my paper. Thank you very much.
Thank you. Thanks a lot, Mr. Tadas, for very rich presentation today. This was very stimulating, and as you the paper has already been completed by you, and after today's discussion, RIS would be very glad to circulate it once you update it. I would now turn to our panel for discussing and further highlighting the issues that you have raised in your very rich presentation, and earlier Ms. Shamala Gopinath also mentioned the context and policy leads. I would now turn to Professor Stephanie Griffith-Jones for her remarks. As I mentioned, she's one of the most eminent voices on national development banks. She has almost taken advocacy positions on how we address and how developing countries, be that in Africa or in other developing countries, the challenges for making finance available to people, particularly from inclusion perspective, is what she has been focusing. She has published extensively on several of dimensions of this issue with Professor Ocampo, who also was part of the ECOSOX initiatives that are there. She was at Chile and has also been at IDS and at university where she is right now heading the center. So without further ado, Professor Stephanie, the floor is yours. Can you unmute yourself, please? Please unmute, yeah.
Can you hear me now?
Yes, please go ahead.
Thank you very much for the invitation. I'm delighted to join this and to participate in the discussion of this really good paper that Mr. Tadas has just presented. Thank you very much. As you mentioned, I am quite a keen supporter of development banks, but luckily in the recent decade, I'm not alone. I think that support for development banks, particularly good development banks, has grown worldwide, especially having a sort of renaissance, I would say, especially since the global financial crisis, or as Indian economists call it, the North Atlantic financial crisis of 2008, 2009, and even more now with the COVID crisis. And one important reason is because private finance has been so procyclical for long-term investment, but even for working capital during these crises. And this market failure has been corrected in part only, especially well in countries that have well-functioning and large development banks. But as the paper presented just now explains, there are other market failures. One is this boom-bust behavior, but there's also the inability of private financial markets on their own to provide sufficiently long-term funding. And therefore, for countries like India, it's very key to have public development banks which can help fund long-term infrastructure needs. But it is also true in other cases, because wherever there is great uncertainty, private finance doesn't want to go in or go in on their own. For example, banks have played a very important role, and as was mentioned, also for SMEs and for poorer people. But beyond dealing with market failures, I think there's also the idea that development banks can create markets. And there is now, Mariana Mazzucato started to talk about the entrepreneurial state. We used to talk in the past about the development state. And I think that development banks, if well managed, if well run, can play a very key part in providing instruments to implement national development strategies. And I think sometimes there's too much emphasis only on the private sector. I think what we need is a new kind of development finance paradigm where we mix both public and private. We combine, we go back to the post-World War II consensus on this. And we try and capture the best of both. I think a debate between, state versus market is a bit futile. We need to see how best they can collaborate, what their comparative advantages are, and so on. So I think it's very important also to think of this investment for structural transformation. And as was briefly pointed out already, most successful emerging and developing countries, but also developed countries, have quite significant development banks, starting with Germany and KfW, China, France, South Korea, and many others. And after the global financial crisis, all development banks, including multilateral, regional, and national, played a very important counter-cyclical role. For example, the European Investment Bank, which is the largest multilateral bank, had its paid-in capital doubled by member states, and then it launched the Juncker Plan, which with about less than 40 billion euros has managed to leverage, working with the private finance, over around 500 billion euros in the last 5 years. So this is one thing that has been very attractive here, for example, in Europe, is the ability to leverage fiscal resources by co-financing with the private sector, by raising money on capital markets, and by having instruments that can create leverage. This is what the Europeans like to call doing more with less. Of course, it has limits, but it does help. And today, practically all European countries have a development bank or more than one, or they are in the process of creating one. So I think this is very interesting. And of course, in Asia, you have also led the way because you have created, and India is very much a member of both the Asia Infrastructure Investment Bank and the BRICS New Development Bank. So this, I think, and now, of course, in COVID times, it's beyond any kind of ideology that development banks are playing a key role. The KfW is putting on the table at least 100 billion euros in just one country to help with the response for COVID, as an example. And the EIB, the European Investment Bank, is talking about 1 trillion euros over the next few years. Overall, there are more than 400 development banks, if we consider multilateral, regional, national, and subnational in the world. And the total assets, I think this is quite interesting, is over $11 trillion of assets, which is actually equivalent to 70% of the entire US banking sector. So we are already on a very large scale. And each year they commit about $2 trillion, which is about 10% of the world gross fixed capital formation. So we have suggested in an article with José Antonio Campo and Regis Marodon that if they increase their lending by 20%, say this year, as a response to COVID, they could just on their own mobilize 400 billion. And if they have some kind of co-financing with the private sector at a minimum leverage of 2, you could have 800 billion on the table available for long-term investment. I want to just outline quickly the 5 crucial roles. One is the counter-cyclical one. The other is funding structural transformation. The third is funding infrastructure, which is so central to development of countries like India, financial inclusion, and then supporting and funding crucial public goods, particularly preventing and mitigating climate change and adapting to it. Now, returning to the subject of national development banks, in the global financial crisis between 2007 and 2009, according to World Bank data, they increased their lending overall in all countries by 36%. So we had a very positive response in the financial crisis when countries and economies needed it. Then I would like to say something, because I hear a lot about how in India capital is very expensive. I think that in many countries, development banks, though having paid in capital supplied totally by government, and therefore being government-owned, raise their funds on local capital markets, and they co-finance with private actors. And in many countries, the rating of the development bank is the same as that of the government. There is not a need. So then the cost of capital, the cost of the funds that they borrow on the capital markets, and I want to come back to that, is very cheap, and they can therefore lend quite cheaply, both to SMEs, for infrastructure projects, and so on. I would just like to summarize very briefly what we learned in this book that we did with Ocampo and the project before, where we studied 7 countries, China, Germany, and 5 of the major Latin American countries. And we concluded that development banks on the whole in those countries were efficient policy instruments, overcoming major market failures, that they were able to adjust through time, which is important to the changing needs of countries, and help fund national development strategies. And also that they were beginning to play an important role in funding green investment to help meet the Paris agreed NDB plans. That they were good at supporting key new sectors like renewable energy and energy efficiency. And I think there, the examples of KfW and the China Development Bank are really interesting, because it was first KfW who was the sole funder, for example, of solar energy in Germany. And then it gradually catalyzed funding from the private sector. And Germany was a real pioneer in solar energy. Of course, then the role was taken up by China, which in some ways outcompeted Germany, but produced incredibly cheap solar panels that have helped spread solar energy throughout the world. So there was an externality of the action. And this was largely funded and supported, even in discussions with the government, by the China Development Bank. And therefore, I think that this is an important case of how two development banks in two crucial countries, the KfW in Germany and the CDB in China, helped develop a crucial sector for their countries, but also worldwide. And therefore, we concluded that expanding NDBs where they exist or create new ones where they don't or where they don't work better really serves well, on the whole, the needs of the real economy. Very briefly, and I think that this supports the case for doing something similar in India, such a previously such a successful country, and which needs to restore dynamism and provide a transformation to a greener and fairer society. And this is one tool that can be very helpful. Just very briefly on COVID, I would like to mention that development banks have responded very quickly to what is now, first of all, a massive need for liquidity, of working capital for many companies. And this has helped save companies and save jobs. And they have seemed to be adjusting very quickly, not funding at the moment so much long-term investment, but funding working capital and doing it tremendously quickly. They have fast-tracked their approach, and they sometimes disburse in less than 24 hours. They've opened new lines for the health sectors, but they're all thinking about how they need to also keep a focus on what is called Build Back Better. That is to try and undergo this structural transformation to a greener and fairer economy. So I would like to also mention very briefly that I'm involved in an initiative, and I'm very happy to provide more details, which is called Finance for the Common Good, and which is partly a research initiative, and partly it will have a major research conference and then a summit, the first summit of world leaders on development banks in November. It was supposed to be in Paris. It physically still will be, but most of it will be done online. And you're very welcome. We have 5 working groups which deal with many of the issues that were outlined by the previous speaker, which are, so we have 5 working groups on the business model, that is the instruments for banks, on regulation, on how to convert development banks better as an instrument of meeting the SDGs and particularly climate change. And then we look at specifically how can they finance green infrastructure. And finally, the global governance of development finance, which is being written by José Antonio Campo. But I want to finish by focusing very much on the preconditions for success of development banks. And I hope this may be some use to India. I think we have to have both a broad context, or if you like, external conditions for success, and then, of course, focusing on the development bank itself. I think the broad context is really important. The country has to have good and counter-cyclical macroeconomic policies, has to have good financial regulation, but it also has to have good systems of pricing. This was alluded to by the previous speaker. For example, good system and pricing of utilities, so that if this development bank lends, for example, for infrastructure, the projects will know what the future level of pricing will be, and the level of pricing will be sufficient. Of course, in the case of providing electricity, for example, to poor people, there may be subsidies involved, but again, the rules have to be clear, and the projects have to be viable commercially once the subsidies are in. I think it also needs well-functioning and well-developed financial sector, including mechanisms for long-term investors like pension funds and insurance companies, as well as long-term retail investors, to channel their excess savings into long-term investment. And this functions well in some countries, not just in very developed countries, but for example, it functions well in South Africa, it functions well in countries like Chile. So I think that it could function well also, of course, in countries like India. Because development banks can be an ideal channel if they're well run. And these banks, like KfW, like Canadian Development Bank, like European Investment Bank, but also the China Development Bank, are largely funded on the local capital markets. They sell bonds. Indeed, the China Development Bank is a very interesting example because it actually helped create the bond market because it needed local capital. And so therefore it has played a big role in developing this bond market and then has used it itself. Other development banks have helped create markets in local currency bonds or green bonds. So they can themselves, also the development banks can play a proactive role, of course, together with governments and regulators. I think, of course, the last precondition is that the country has a clear development strategy linked ideally to a sort of modern industrial policy. And therefore, within that, and I'm passing now to the preconditions of the development bank itself, the development bank needs to have a very clear mandate. What is it supposed to do? And I think the previous speaker also referred to that. I think it's also important that the development bank has a sufficient scale, that it is properly capitalized by the government. Because if it has to play an important role, it needs sufficient resources. But thirdly, it needs good governance. We're talking not about any development bank, but about good development banks. Good accountability, excellent professional staff, excellent boards. They have to be, it's quite a difficult balancing act. They have to be close to the public sector to understand the priorities of the development strategy, and they have to be close to the private sector to be able to co-finance with them and generate the necessary financial resources and financial instruments to achieve that. But they must not be captured by narrow interests, either in government or in the private sector. So this makes it a challenging task, but a feasible one. And they have to be transparent and accountable. I think that one thing that is interesting is that, and can give you a lot of hope, is that banks, even if they're not working well at the beginning, can be improved. The chapter on China in our book is called Born Bankrupt, Born Shaper, because the CDB was initially bankrupt. And instead of closing it down, the profitability has been improved. Now it's completely focused on being commercial, and it has done really well. But initially, it had serious problems. Of course, it's better if you create a good development bank from the beginning. But even if you have a development bank that doesn't work so well, it can be substantially improved. And there are also cases in Africa, in sub-Saharan Africa. There's one that is very well known, which is Uganda, the Uganda Development Bank, which also had serious problems, very high non-performing loans, etc. But it has actually significantly improved, and now it's recognized internationally, and it gets a lot of lending from international institutions. And finally, it has to have appropriate instruments so that each, I don't want to take up too much time, but according to different functions, you have to deploy the right instruments to maximize leverage, but above all, to maximize development impact. So I hope that this has been useful, and I congratulate Dr. Sachin for the initiative and for the paper that has been presented, and I wish you all the best in Development Bank future. Thank you.
Thank you. Thanks a lot, Stephanie, for very insightful comments. Those of you who are further interested, may get this interesting book that she has come out with on national development banks, what kind of role they are playing. The book is there. It's on RIS website. We have put the details, but that they can also be accessed. I have, friends, now great pleasure in inviting Dr. Janmejay Sinha, who is a chairman in India for the Boston Consultancy Group. He's also a member of the Henderson Institute Innovation Sounding Board of the BCG, and has been there with BCG for quite a few years. He joined it in 1998 and has been contributing. But he's an old hand with the Reserve Bank of India, and from there he came out with BCG. And while being in RPI, he was connected with several of the initiatives which were of great importance in terms of the issues that we are discussing. But he has also served on several expert committees, and I have heard that he's one of the consultants who is in greatest demand in this sector. I haven't met him, but it's great to have you on our RIS platform, Dr. Sinha. Very warm welcome to you. The floor is yours.
Thank you so much, Dr. Chaturvedi. It's a great pleasure to be talking here, and Gopinath in RBI, and she has learned to tolerate my bluntness. So I will continue in that vein to be blunt. Our former Prime Minister Vajpayee used to quite often like quoting Oscar Wilde, saying that every saint has a past and every sinner has a future. And so it is with economic policy, that the policies that are supposed to be condemned have a future, and the policies that are in great fashion have a past. And we need to just be cognizant of that as we think about what the issue is. If you look at even the pandemic today, the reason that we are all very hopeful that we will get a vaccine in the fastest possible time — a vaccine normally takes 5 to 10 years to develop, but in this one that it might happen sooner, because the nature of the effective demand for that, the nature of the rich countries that are affected are so strong that there will be a rush to create a vaccine. But unfortunately, in economic thinking, my dear friend Rakesh used to talk about lazy banking and never answered me when I would say, what about lazy intellectuals, especially lazy intellectuals who came from the IMF and the World Bank to India and stopped their thinking after they came back to India? Because, some of the issues that have come up with regard to our DFIs were post 1992. And I was actually, as a consultant working for IDBI during the period it got converted from being a development finance institution and was forcibly converted into a commercial bank, despite all the protestations that I could possibly make at that time. Mr. Narayanan was then finance secretary, Rakesh was the economic advisor, and we had a fairly contentious meeting in UK Sinha then used to be joint secretary financial institutions, as it were. And it was a pretty strong cast, and we tried to explain that there is a very important need for the DFI to continue. And Mr. Narayanan, who was then finance secretary, kept arguing that they only make bad loans, so there is no point throwing good money after bad money. And it took me almost 1 hour to explain to him that he was looking at a very small part of the problem, because the problem in 1999 and 2000 and 2001 with IDBI was that they were borrowing at a higher rate than they were lending. And I said, in living history, no business model has worked where you borrow at a higher rate than you lend. And so just forcibly converting this organization into a commercial bank, and that too merging it with a small piddly IDBI bank, is really quite a difficult situation for it. And then I really don't blame IDBI at all, because they were merged into a very small institution. They had to deal with SLR and priority sector lending, and so the entire focus went away from infrastructure completely. Project finance was dead. ICICI was made to go away, IDBI was made to go away. And then what did we do? We created IDFC. And IDFC, because we believed that they would not need to lend directly, but that they would borrow from the market and they would facilitate lending. Now, when we don't have bond markets which are deep, that is what I call lazy thinking. Because all we wanted to do was import from the Anglo-Saxon models that were existing what was working elsewhere in a time of development totally different from India, and so we were completely ignoring that we should have been looking east when we were looking west. And that was a real basic problem. So what did we do? We created IDFC. What is IDFC today? A commercial bank merged with a finance, an NBFC. And the small part of the project finance that was left merged with a new experiment called an NIIF, which also has shown nothing in terms of project finance. Then in between, we came up with another institution called IIFCL. All the time, when the logic for IDBI, ICICI, and IFCI stayed as robust as it was when they were created. It was a matter of great shame that our thinking could not incorporate within it the need for infrastructure development, because the productivity of our economy was not rising fast enough. The capital was being put in, and that was how we were growing. The productivity was not growing fast enough. So with the 12th five-year plan, what we tried, and at that time Montek, etc., were in the government, they said, we have the economy is only $1 trillion in size. We need $500 billion of infrastructure. We are going to use public sector bank balance sheets to try and get 40% of this funding done through PPPs. And 67% of those PPPs went sour because of lack of policy clearance. Either environment or land or mining clearances which were not given. So in the period between 2007 and 2013, we had, of the 5,900 projects of this kind, 3,000 being stuck for policy inadequacies. And everyone knows in a project finance, if for 2 years you don't get clearances, all your equity is wiped out. So where are we now? What are the lessons that we have? We all understand that you cannot, no asset liability mismatch can be that strong that you will borrow 3-year money and lend 10, 15-year projects. It's impossible. It's a fundamental issue with shallow bond markets in India, and very thoughtfully we have not exposed ourselves to external commercial debt in that way. So I actually think that the logic and the need for a infrastructure DFI is actually quite important. An infrastructure DFI which can actually access funding, can have duration funding, and actually lend for purpose. The issue is, for it to be able to do that, the China Development Bank, has the same thing. It was of basically, the borrowing was SLR. It was basically government approved. And the NIC LTOs, was just what, 10% or 5%, Mr. Tadas would know that better, of the RBI profits. That percentage, for infrastructure would not have been a bad thing. In any case, the Indian model was a banking model in 1969 and 70 when banks were nationalized. There was a real logic for it. The logic was we were a basket case. We had no money. No one was interested in lending to us. So the only way for us to develop was to actually get depositor money in. And to get depositor money in, public sector banks were pushed to open rural branches and semi-urban branches by which they collected deposits, of which for periods of time, certainly over 40%, often close to 50% was CRR and SLR. money that used to go towards our plan expenditure. And then there was 40% priority sector lending, which was to give money to important, interest groups in a political economy, which had adult franchise from day one. So we had to do more social spending than any other country. And then we used to allocate. I used to be in the infamous IECD to allocate credit under the credit authorization scheme, which was quite a novelty because bank board approved loan approvals would be given by this 24-year-old. I mean, it was a fascinating period. But the logic was of a certain understanding of the context of a very poor country trying to develop very fast. What happened with the structural adjustment program of the IMF? Well, there were many good things that came with it, in terms of the abolition of certain completely hampering regulatory environments of the MRTP, the exchange rate became closer, our tariffs were brought down. So the economic impulses of the economy were made stronger. The market forces were improved, but we threw the baby out with the bathwater. Because for project finance, to imagine that commercial banks or new private sector banks, which were so small, would actually be able to lend towards project finance was just a mistake. And then we kept trying to correct that mistake with IDFC and IIFCL and then NIIF. My view is that there is a lesson in India which could be globally relevant. Instead of us always looking for best practice and global best practice and Western global best practice, what we should start trying to understand is what is India's current context and need, and how do we address it? How do we address our current context and need, not that of some developed country which has a per capita of $40,000. We have got a per capita which is sub-Saharan Africa. We may be a large country in terms of GDP, but our per capita is small. So, we have to recognize the limits of the financial sector's depth other than out of the banking sector. Given that, I think we have now what could be the seed of a model which can actually marry the market and the government and the purposeful need to increase our productivity. A DFI, which I have a slight concern with what Mr. Tadas was saying, so I will just put a comma there. I would say that it should be a bit narrower focus than the kind of things he wanted in it too, like SME and financial inclusion. I would say let us just look at project finance first, because it is actually a big deal that needs to be addressed. Let us allow it to access concessional funding and then allow that to be owned in the IDFC model of 40% by government and 60% by private sector, so that governance and HR autonomy is there with this institution. And some metrics are there of measurement that ensure that the best people go in there and are constantly challenged. We forget that IDBI, when it was created, and ICICI, when it was created, it was pre-1992. The best people used to go into these institutions. Post-2000, the gap in compensation between the public sector and the private sector really spread out. So I am a Bihari. In 1980s, when I was coming out of school, people, my parents used to say, you would be twice born. Bihar mein koi IAS you would never join the IAS. IAS ban jata tha, twice born. So that was, the government was the only place. And so a lot of talent used to be available to government. Now we have to fix governance and autonomy, give purpose, recognize our need, and create a development finance institution which has the mix of the market and the government, has concessional funding, and can actually support project finance. That is what I believe is required. We have continued to try experiments by, what I call cheap experiments, that we will not put any money, but we will actually try and just get leverage. First, we need to put money, then we need to get leverage. We can't just get away from the fact that we will also have to put money. If we can't do that, then the government will have to directly put money. because no one else is wanting to lend for project finance because they have all burnt their fingers, and they will stay burnt post-COVID for even longer. Given that the public sector banking system will take a big hit right now and will need 3 to 5 lakh crores of capital if we have to follow Basel norms. So that's some small comments I wanted to make, and I will stop there, and I look forward to the conversation. Thank you.
Yes.
So
Sachin.
thanks, Mr. Sinha, for very stimulating remarks. Thanks a lot. I would turn to Madam Shyamala Gopinath for if she wants to come in now, or be open for. We have another 20 minutes or so for discussions before we go back to the panel at 5:20. So we have few minutes, and we are flooded by questions that are pouring in, question answer, and also in the chat box. I would request everyone to quickly put in the chat box. But we also have questions, as Ms. Gopinath, you might have seen from Mr. Shailesh Pathak, who has written to you directly. But we also have from Mr. Abu Bakr from Uganda, who has sent a question, and we also have from Mr. Adhana, Maghera Madhana, who has raised some issues about the funding and sustainability issues. So I have requested my colleagues to unmute Mr. Shailesh Pathak and Mr. Abu Bakr and Mr. Adhana if they want to put their questions directly, and then we would move forward. So,
Yes.
Madam Chair, with your permission,
Yes,
Mr.
sure.
Pathak, are you able to speak now? Are you already unmuted?
Yes, I think so. You can hear me, right?
Yes, we can hear you.
Madam Shyamala, I really appreciate your opening comments, and thank you all panelists. A little bit about myself. I joined the term lending financial institution of ICICI in 1986.
Oh.
And my first day at work, I raised 100 crore a bond issue because it was SLR. And
Exactly.
the fundamental point that you made is cheap credit leads to cheap on lending. And, Jan made that point in the end. You have to have access to cheap credit. Now, I have also been part of IDFC in 2007. And IDFC in 2007 was very different from IDFC, let's say, in 2017. So our experiments somehow with development finance entities, and I'm not even going to Power Finance Corporation. I'm not even talking about the potential NPA in the portfolio of IIFCL. So in terms of the governance system or the mechanism, what Janmejay said was you have less than 49%, which was the IDFC model. But how do you cope with the political direction to lending? This prime minister may change. We might have some other prime minister, and we might have another finance minister. So specific suggestion was, I have actually in my company, we do infrastructure projects, and we have a 49% shareholder called Canada Pension Plan Investment Board, the largest pension fund of Canada. They have a very interesting governance system. They were set up by a federal act of parliament by Canada. And another very interesting model is the Australian Super Fund, the superannuation fund, the largest Australian fund. So unless we come up with that kind of governance model, politically directed lending and suboptimal lending would probably not be ruled out. And in this context, as Ms. Stephanie said, the China model is worth looking at. Janmejay said, look east, not west. But then China has a very, very different approach to political economy. That was my only question. Thank you.
Yes, yes, Pathak, you're right. I mean, you've got experience in all the experiments that we have been creating, and you're fully aware of what has happened to IFCL and all. So one really wonders, we've set up so many. I mean, we've tried so many experiments, the DFIs in the in the highly regulated periods, we had licensing and all that at that time, very regulated environment, high tariffs, so everything was high cost. Even post that, when we set up IDFC, it didn't work. And they had to again go for a different model. In fact, they went away, I think, from infrastructure. And now we have the IFCL, then we have PFC, so many of them. So I think fundamentally what is required is like what you said, in like the Canadian Development Bank or the Australian Fund. Both of them have government equity in them, isn't it? The Canadian Development Bank is entirely funded by the government. I think that's what I think.
So this is the pension fund, and this is the investment board for the pension fund. Thank you.
Fund. And a pension fund at least would have pension funds available to them, long-term money. And these pension funds are allowed to invest in private sector projects in other countries, in emerging markets. And that's how we have huge interest from these entities. In fact, that's what India really requires, what even Janmajay is saying. And even the other speakers also said, is if we create an institution with good equity from the government and the private sector, we could leverage, we could raise funds from these institutions. I think, but the most important thing is about our projects. So how do we ensure that these projects yield a return which these investors are seeking? And particularly foreign investors they're also exposed to the exchange risk. So they would factor in all that when in their expectations of returns. I'm sure we could have domestic long-term money also coming in from savers. For instance, may not be very long-term, like 20 years and 30 years. But I think many of you all know the recent, when the government had what it's called RBI bonds, that 7.75% 7-year bonds, when the government suddenly realized they were getting huge amount of money into that, particularly in this risk-averse situation when people are so scared about investing in risk instruments, huge amount of money, they suddenly realized they were paying excessively for a risk-free bond, and they stopped it. And I know how many of these potential investors were so upset. So maybe we could, there are HNIs and high net worth investors and even other retail investors looking for investing in little longer term instruments. They may not look only at the pension, pension fund option, even at other options. But clearly, I think what is required is the confidence the investor has that he will get the money back, that he will get the returns, if not fully, at least some, he would get the expected return. So, in fact, one of the reasons why the corporate bond market also, every time there is one failure, we go backwards. Suddenly there's no interest in investing in any risk on paper. So agreed, Fatak. I think with all that experience that we have, tremendous experience, we should be able to build either a new institution or convert IFCL into a development bank with all the resources. And basically what happens in a 100% government-oriented undertaking is that the risk-taking ability is not there to the extent which private sector is ready to take for various reasons. And in India we have the other issues, the 3 C's, and rightfully so. Public money can't be spent in any way, and therefore even to expect private sector to bring in funds in a 100% government-owned entity requires a governance structure which the private investors will have confidence in. That there will not be interference, like you said, no politically directed lending, and that all projects financed by this institution will be purely based on viability. So let's hope, I'm hoping what Janmajaya suggested and all the others suggested, that the thinkers, instead of lazy intellectuals, we get hold of somebody who can really come up with a model that works. I mean, we won't know in advance whether it works, but at least something that is acceptable to investors, potential investors, either debt investors or equity investors.
Thank you. Thank you.
Yeah.
Thank you, Ms. Gopinath, for taking it up. There are two more questions. One is from Mr. Abu Bakar from Uganda, and he wants to know why it is not cheap to buy the resources that are possible or access resources from foreign countries. So he has articulated his question and has sent to us in terms of why external financing, which is usually cheaper, I will appreciate to know why it is expensive for India or for others. I am from Uganda, Abu Bakr. And then there is a question from Mr. Adhana, who says that he runs an NGO for sustainability and how he can work with IDBI and HDFC Bank. So,
yes.
so maybe, Madam Chair, if you permit, we go to our panel for 1 minute each, and then
sure.
you give the closing remarks.
No, absolutely.
So we go to Mr. Tadas for any response that he may have, because we are already running over time now. So Mr. Tadas, and then I would come to Stephanie. So,
Thank you. Briefly, I will summarize. First of all, thanks all the esteemed panelists for their very critical inputs and important suggestions. Yeah, I agree. The resources is going to be a critical issue, and for this we need to work out the different models as have been suggested by panelists and other participants. Whether we need to depend on SLR bonds again or tax-free bonds again. Yes, I think we need to depend some extent on tax-free bonds if we need to finance long-term infrastructure projects. And what is wrong with that? This is my view. Now, second is why one of the participants has raised a question on why we are not able to raise cheap resources through ECBs. Well, any external raising of resources is contingent on the rating of the country. So if you see that, and also what is the standing of the borrowing entity. So going by that, it has always been our experience that somehow we have been borrowing at a slightly higher rate than what it is available to other entities in the developed countries. Third, yes, it's very important to look at what should be the structure of the new institution. I agree, there are so many existing institutions, whether we can consolidate and create a new DFI, which will address the national developmental goals, and think of a governance structure which will make it performing, efficient, and accountable. And we need to have a review mechanism so that from time to time we review the mandates and then see the relevance and then see in what way we can make it relevant so that it continues to play a critical role in the national developmental goals. With these two observations, I stop here.
Thank you, Mr. Tadas. May I now turn to our panelist, Professor Stephanie, and then Dr. Sinha. You may like to, unmute.
Can you hear me?
Yeah, we can.
I like very much Mr. Patak's comment that said that you have to first capitalize and then you can talk about leverage. I think the government of India needs to put some resources into this to capitalize existing banks or create a new institution, and then look at the best ways to achieve leverage and to achieve development impact. I think the very nice comments made by Shyamala, there is, I think, a very interesting case, which is KfW, because it has support from both main parties. So whether the Christian Democrats or the Social Democrats or both are in power, they all basically support the KfW and expand its role or adjust it, with, of course, nuances. The Christian Democrats are more market-oriented, Social Democrats are more public-oriented, but they all see the KfW as a key actor in Germany's development. And this is what is so difficult in developing countries. For example, in Brazil, it's a bit of a political football, because if you have a left-wing government, they expand the BNDES role maybe too much, and then if it's a right-wing government, they cut it back too much. Although even now in COVID, they are quite keen to use the development bank. So I think you have to create institutions that are efficient, but that also, like Caesar's wife, are seen to be efficient. And then she made a comment about political lending, of course, is bad when it means being captured by political narrow interests or corruption worse. But what you can have is policy lending. You can say in an arm's length way, I want you to lend more to renewable energy. But then you let the bank choose what are the best projects, the most commercially viable projects. So you have to be policy oriented, but not political, which is, of course, easier to say for an academic than to actually practice. Then there was a question about cheap resources abroad. Well, resources are cheap abroad if the exchange rate is stable, but if you have a massive devaluation, as all economists know, they may become extremely expensive. And I think India borrows quite a lot, wisely doesn't borrow from the international capital markets for development banking, but it tends to borrow more from multilateral development banks. And I think that's a good thing, but it has this problem of currency mismatches. So if you can, the more you can borrow in rupees, the more you can deepen local capital markets. I mean, you have very large savings, you have such a large economy, you should be able to develop your own capital markets. And I very much agree with Mr. Tadas about the need to review mandates, to be flexible, to look what today India needs, and adjust existing institutions or new ones to these needs. Thank you.
Thank you. Thanks, Stephanie. May I now turn to Dr. Sinha?
So a few quick comments. The first is when I said East, I meant not just China, but Korea, in Japan originally, and Taiwan, and at the times that they were doing it, and they had a certain structure. The second thing is that I am a conservative in respect to external commercial borrowings, and the 2014 to 2018 period, RBI misread the market on interest rates, and so we became the haven of the carry trade. We were getting a lot of money, and the rupee was very, very strong, much stronger than it needed to be. Our exports went down, and so we could not, we made one of the issues with regard to if you affect your exports, then even your foreign exchange reserves are not really yours because they are old. The thing that India should not do in respect to project finance is to create policy risk. We should have project risk and not policy risk. The biggest problem that we had during this period, even say from 2007 to 2013, was policy risk. If we want to score a self-goal, that's fine. Then let's not blame and cry, because if we should only have approved projects for financing, approved by the state government and the center, otherwise no financial institution should touch it. Right now, if you look at the Pune Metro, I mean, it does not require repeating. If you can't even insure projects from policy risks during the appendency, if you have that poor policy predictability, then we should not talk seriously about project finance. It should only be done by government. If we have financial institutions should do it, they can evaluate project risk, they cannot evaluate policy risk. That's a quick comment here. Thank you.
Thank you. Thanks, Dr. Sinha. May I now turn to the chair of the session for her closing remarks, and then we would close.
Really, yeah. Just to on this the policy risk, I think in several projects the banks that have lent have faced serious. I mean, there's just no predictability of policy, and ultimately it's the banks that are holding the baby there. So whether it's the coal mines, license being cancelled, or spectrum, all this actually ultimately affected the banks, and these things are really not good. And there's been a whole lot of examples on policy predictability. On external financing, when I was deputy governor, we used to always have this tension with the companies, everybody felt that, borrowing from overseas is cheap. And, and particularly now I can say I can understand, and I'm sure people are just wanting to borrow more and more with almost a zero interest rate policy, zero interest overseas. But, the exchange risk, I mean, we used, even at that time, we said infrastructure projects where the revenues are from in rupees, in domestic currency, it doesn't make sense to borrow in foreign currency because, the currency risk mismatch is there, like Stephanie was mentioning. It doesn't, it simply leads to India, borrowing, actually it results in a higher cost borrowing, but it also, particularly if such borrowing is through financial institutions, it's a greater risk because, the general expectation is that financial institutions will not fail and they'll honor all their obligations. So it almost becomes like an insurance or a guarantee for, for these kind of returns to the foreign investors. So we have been, and I'm glad Janmajay said that we need to be conservative, particularly when the revenues come only from domestic sources. Well, the closing remarks, I don't want to take too much time. I really found all the comments extremely interesting. The examples, really something which we can look at. And the German development banks, have always been something we look at since, that is something like it's both it's not purely market-based model, but it also has, satisfies the objectives of what market really is in terms of the governance and in terms of efficiencies and the utilization of the funding, although there is a government backing to that institution. If at all we can achieve that, and then we will be able to attract private investors. And I'm sure there are various ways. In fact, in one meeting, both Janmajay and I were there, and we did discuss to say whether, we could have the government equity as well as the private equity both joining together. But clearly what the private investors said was that there should be no interference from government in the sense, on the governance side. And second was really, sometimes we feel that it's not just the funding issue that is stalling infrastructure projects or the project financing. It is this policy unpredictability, the shocks that companies face when regulations suddenly change, when the whole scenario, competition scenario changes. So, and approvals are not given, whether it's land acquisition, whether it's environmental. We have a huge lot of problems, and ultimately we find the financial institutions bearing all the costs of such policy aberrations. So this is, if we deal with that, I'm sure we can always come up with a model for funding infrastructure. Thank you.
Thank you. Thanks, Madam Gopinath. Thanks, Mr. Tadas. Thanks, Stephanie and Dr. Sinha, for very enlightened and very informative, insightful session today. I'm sure this would pave way for a very rich paper from RIS. Thanks, Stephanie, for sharing the details of the meeting that you're putting together in Paris. And I'm sure with this initiative, quite a few of our enthusiasts would like to join and would take this forward. As you said initially, you were among the few, but now the number has multiplied of people who have faith in such an institution. I'm sure this would trigger in as India takes over the G20 presidency in a year from now. More and more of these issues would come in. Next year, India would also have the presidency of the BRICS, where the BRICS Development Bank is. And I think the issues on finance with the COVID-19 crisis, they are looming large at this point. And I'm sure with engagements, this would become possible. Later this week, the Sherpas would also be meeting for the G20 in Riyadh. And I'm sure the development finance and the role of the development finance is again emerging as an important area. We are in very interesting times. where modalities, instruments, and of course quantums matter a lot. Be close for now, but this is an ongoing dialogue. I'm sure we would be back with another very important seminar. Till then, a very goodbye. Thank you. Take care. Stay
Thank
safe.
you.
Sachin
Thank you.
and
Thank you.
Thank you.
panelists.
Thank you.
Yeah.
Thank you.
Thank you.
Thank you.